Good morning, everybody, and welcome to today's session. Today is our second session of 3 sessions for Get Ahead 2025, and this, of course, being Audit Level 1. Now, in Audit Level 1, just to make sure that we all remember what we're doing in Audit Level 1, this series of sessions is aimed at trainees or audit staff who are maybe less experienced, who haven't done a lot of auditing. So our intention really is to ensure that we help you to basically get going, to make sure that you know what you have to do, how you have to do it, when you have to do it, how to use the software. Let's start with where are we today? All right, so for today's session, we are going to address these 3 topics, as we've said, and there are 3 individual recordings of each of the sessions where we work through the theory, through the material, look at how we identify the risks, what's included in those accounts, and then in those recordings, we also started working in the material itself, in the files. So you would have downloaded the caseware file from the Success community as part of your resources, learner resources for level 1. You'd have downloaded the caseware file with a lot of supporting documents and things as the client would normally have given you, and you would then have started to complete some of the audit work for both cash and cash equivalents, general expenses, and employee costs. And today we are basically just going to continue with those parts. All right. So I see here someone saying, I've struggled to get the link for the 14th session. Please, Belisa, can you just confirm? Oh, you're saying 14th of Feb. So I don't know if you want the link for the recording. I'm not sure if that recording is available yet. We'll have to look, but we will definitely let you know as soon as they are available. Right. In fact, I see the dean saying that it's not available yet. So hopefully that will be made available in the next week. All right. Yes. I see that she's saying that. Good. So that is still outstanding. But remember, that does not keep you from doing the work on the Moodle site. All right. So on the Moodle site, the Caseware Academy link, there you've got the recordings of, I think there were 3 sessions for the probe users, 2 for the Audit International, for the session that links to the 14th of Feb, the first session in our series of level 1. There were 3 recordings for this week's session for these 3 topics that we are addressing today. And then there are 2 more topics for the next and our last session, which is on the 11th of April. So if you have not yet managed to download those items or that material, I would strongly suggest that you download the material from the Success community and that you get that ready. We are going to actually work in that caseware file today. We are going to actually work through it. I see Vadine is loading the Caseware Academy, the e-learning or the Moodle page for us there. That's where the recordings are of the sessions for pre-course work. And then we will also shortly see where we can get the material for today in terms of the work that you would have worked through already. So the caseware file and the supporting documents. All right, so that's where we are. We've worked through the first topics on the 14th of Feb, session 1 of the series. Today we're doing the second one. And then towards the end, we'll also see what the last series or the last session in our series is going to be. Good. As a recap then, or as information of what is involved, the important thing for us is always to think about where do the items or the accounts or the disclosure in the financial statements come from. We always start with thinking about where do the amounts and the disclosure come from in the financial statements. So we've got the financial statements, but note that it's right at the end. That's the end product that the client's given us. But there were a few things that happened between the start of things and the actual financial statements. So we'll have the client uses the trial balance and other information to prepare those financial statements. And maybe an example of the other could be something like a facilities letter where the client uses the facilities letter that discusses items provided for securities as securities for the facilities, the credit facilities that they have. So that's a letter that's not recorded in the trial balance because it's not a number as such in the trial balance. So those other documents not part of the trial balance and the general ledger is also used to prepare the financial statement. So we also need to be aware of those. Then, of course, the trial balance and the general ledger, the cash book, right? All the payments and receipts recorded in the cash book in bulk. So that is also part of what we are looked at. And then also the bank statements. So the bank statements are used to record the cash book. And what is used to record the bank statements? Well, there are actions taken. So purchases, paying a creditor, clients paying for us, etc. So those are all the actions that happen. And if there's a cash element to that, then there will be a payment made, a receipt from a customer, etc. And those all get reflected in the bank statements, recorded in the cash book, and ultimately done in the financials. So whenever we are looking at auditing the financial statements, we need to take into account what the process is, what came before that, so that we know where we want to go and look at supporting documents to substantiate what is in the financial statements or what should be in the financial statements, etc. Then another picture, the focus is primarily on almost the triangle that is done between the accounting framework, the audit, and the financial statements. In saying that, the accounting framework ultimately drives the financial statements and also drives our focus from an audit perspective. So what is important here? When the client prepares their financial statements, they need to do that in terms of the financial reporting framework. In this case of our case study, that is IFRS for SMEs. Could also be IFRS or another framework. So financial statements drafted in terms of the financial reporting framework. Then, for them to get to a point of actually accounting for items, if we think about our previous slide, accounting for the transactions, accounting for the matters that are recorded in the bank statements and ultimately in the cash book, etc., they need to have accounting policies. But important, those accounting policies needs to be in terms of the framework that the client chose. So my accounting policies must comply with the framework that set the principles. So the client's accounting policies cannot be contradicting what IFRS for SMEs says in this case. So I chose my framework, IFRS for SMEs. What are the policies that I have to have, or where do I have choices for accounting policies? And then to check that not only did the client choose the appropriate framework, they are allowed to use IFRS for SME. It is an appropriate framework for them. Not only did they choose the correct accounting policies for their business in line with the framework, but lastly, thirdly, they also did the accounting, and that's where the last bubble comes in. They also recorded transactions, events, balances in accordance with their accounting policies, which is in accordance with the framework. Right, so that's important. So also when we are auditing, we basically follow a process. They're often done in different documents, but essentially we are following the process of saying, is this framework appropriate for the client? Then when we get to the account balance or the class of transaction, in this case, cash and cash equivalents, is the client's accounting policies in line with what IFRS for SME says? And then lastly to say, is the client's actual processing in line with their accounting policies? Right, so that then being the case there. And then, of course, also I'm mentioning now the accounting, but don't forget about the disclosure requirements and whether the client performed or included the disclosure as required in terms of the financial reporting framework and therefore the accounting policies. Good. So that's just the financial reporting framework. Now, another thing which we looked at and addressed in a very short way with the completeness, in terms of completeness of the cash and cash equivalents, I wanted to also just mention or make sure that we are comfortable with the concept of how do we test completeness of bank accounts, or when do we test it, or why do we test it, and how do, or everything around completeness testing. Okay, so why is this even something to mention? First of all, remember that we only perform procedures where there is a risk recorded. So if we've identified a risk, in this case, we would have had to record a risk for completeness of bank accounts or completeness of transactions recorded in the bank accounts. Or secondly, if there is a material balance without any risks, in other words, there's no relevant assertion, then the standards expect us to identify the assertion that is most likely to be the one with the mistake. Right, that's my own wording, but that's what it comes down to. And if we then decide that completeness is the assertion that is most likely to be the one with the mistake, then we will say the completeness is our selected assertion, and we will then go and respond to that. Yeah. So in one of those two ways, we got to the point of saying we need to test completeness. We need to get audit evidence about the completeness of the bank accounts. Do we have all the accounts recorded? And or all the transactions and events that were recorded in the bank accounts, whether they have all been recorded in the client's accounting records. I guess to a lesser degree, we can also say whether everything in the client's accounting records have been disclosed in the financials. That's not so tricky. But the tricky part is that years ago, and I'm talking even before my time of training contracts, we used to send a bank recon to clients, to the client's bank statements, and oh my goodness, my words are mixed up this morning. Let me rephrase. So we used to send a bank confirmation to the bank of our client. So let's say the client used a specific red or green or blue bank as their commercial banker. We would then send a letter, a document to them. And one of the questions in there was, are these all the accounts that the client has at your bank? And the bank would tick, yes, this is all the accounts. Or are there any extra accounts? No, there aren't any other, whatever the case is. Then at some point, the bank started saying, but hang on, we're not going to give you more information than what you ask us for. You have to tell us which accounts numbers you want information of. The client has to approve or give us permission to give you information about those specific bank accounts. And we will not tell you anything about any other bank accounts. We're not allowed to. Okay. The second part to that was, if you really think about it, if you're sending a letter to a red bank, the red bank could actually only ever tell you about what was happening in the red bank. They can't tell you about whether there are any accounts in the green bank, the blue bank, the whatever other color banks. So, strictly speaking, it wasn't actually giving you all that good evidence. So, when the practice statement was revamped in terms of bank confirmations and how to actually get information from the bank, there was then a specific appendix included to say, how do we, if we can't then test completeness of the bank account through the confirmation, how do we then test completeness through other ways? And that's the cool thing, actually, is there are other ways to test it. So the first thing is to actually inspect the client's banking system, the actual online banking. You say, Mr. Client, can you please log into your bank system? And I want to just see which are all your bank accounts so that I can see that we do have all of them on the accounts. Or you can word it in a more, almost want to say, in a softer way. You're not trying to insinuate that they haven't recorded all of their accounts. It does happen from time to time, all right? I was saying to someone else the other day, it actually breaks my brain. It feels like I just cannot comprehend how it's possible to actually account for a business and actually forget to record one of the bank accounts. But I have, in my 3 years of training contract, had one client where they had accidentally not recorded a bank account. And it was, I'm quite convinced it really was accidentally. It was an accountant that wasn't very sure of what to do or how to do their stuff. So that was, I believe, an honest mistake. But at the same time, it's also possible that you could actually have clients who are hiding money, sales, and who knows what else in a bank account somewhere. And again, I was just reminded again last week about how a client's one staff member who was giving all the information to the auditors. So that was the only person that they were ever asking a question of. And this person was manipulating stuff because he was hiding things and, really big things. But really, if you start asking and thinking and linking up matters, then sometimes you can actually come across these matters. All right, so we very nicely, politely asking the client to have a look at the online banking system. Now, there's a lot of things we can look at on the online banking system, but the one thing is to see which accounts are listed on there, compare, agree those to what we have in the accounting records, bank statement, bank account numbers, etc. You can even look for the balances, of course, at your end in there, right? And then that then tells us that all the bank accounts at that one bank, the red bank, the blue bank, whichever bank, all of those accounts are now recorded in the trial balance, in the ledger, in the cash book, etc. We know of all of them, but we still need to consider other things. One example being if there's a bank account at another bank. So some other points listed in that practice statement, and that's a South African audit practice statement, just by the way, is to actually do a comparison of individual accounts or which accounts are on the list year on year. Because also remember, you might be seeing 4 accounts this year on the client's bank system, but last year there were 5. So where is the 5th one? Well, it's not just a matter of saying, okay, but last year we had, a investment account or a call account. Call account is often an account where clients move some money to earn more interest. So last year we had the call account. Now we don't have a call account. What happened? Oh, we closed it. Okay, great. Fantastic. We closed the account. Let me go and make a note. But hang on. We're trying to corroborate evidence. Can I please see the last bank statement where that account was closed? Let me go and see it. And then often you can get the last bank statement. You can see the bank statement that says this account has now been closed. Something like that to corroborate the fact that that 5th account should not be in our records anymore or does not have a balance anymore because, in fact, the money was all withdrawn and it has been closed. Okay. Then I almost want to say a standard step in our audit is inspecting minutes. Now, it doesn't mean that you have to go and inspect the minutes yourself. A team member or maybe 2 team members will oftentimes be reading and inspecting the minutes of meetings, directors' meetings, management meetings, etc. Why? Because you will be summarizing or looking at the minutes for a variety of matters that you want to know about. And one of the things you want to see in the minutes is perhaps about something like, are we opening any new bank accounts? Have we decided to close a bank account? Any of those points also being minuted then. Right. Hopefully the client minutes them. I do know that not all clients minute all the management meetings, for example, but directors' meetings or things would hopefully be minuted, and you can have a look at those for some of these bigger type of decisions. Right. Then inter-account transfer testing. So inter-account transfer testing is not transfers in the general ledger between the different bank accounts. Here we are talking about actually, if you're looking at the bank statements and you see transfers between the client's current account or check account or whatever you want to call their day-to-day operations account and another account. So maybe there's that extra money and we want to go put it in the call account because we can earn a little bit of interest there until the end of the month when we need to pay some clients, or we're going to park it there for 3 months, and then after 3 months we'll use it for something. So call accounts, fixed deposits, things like that. If there's a transfer, often these are bigger amounts, if there's a transfer from our current account, our check account, our operational bank account to another bank account, to go and check, inspect that other account to see that the money did actually get there. Because if I'm saying I'm sending it to call account 1, but I go look at the bank statement for call account 1 and the money's not there, it might be that it might be in call account 2, 3, 4, 5, whatever number, and then we need to see that that bank account was in fact recorded in our client's accounting records. Right, so that's what's meant with inter-account transfers. The same thing with when money gets transferred from a call account or another bank account to our operational account. Not just the operational account, you'll go and look at the transfers, but then also to see that where money is coming into the bank account, the check account, was that other cash account, sorry, not cash account, was that other call account also on our records? Because maybe the client sells to a certain industry or group of customers, and those customers pay into a separate bank account, which is not on the records. And the way that they then get the money into the business is to basically transfer it from that other account into this account. And so that's how we could potentially pick up another bank account. And then indirectly through other testing. So maybe through, the one example I gave now was subsequent receipts from trade receivables. If we are looking at trade receivables, debtors, and we say, I want to see where debtor A paid us, and they show us a bank statement, well, maybe the debtor paid into another bank account, or we can just say all of these come from accounts that are already recorded. Right, same thing with payments of creditors, etc. So that is our completeness testing. I see there is a question. I just quickly want to have a look at the question. Can an auditor place reliance on IT3B tax certificates from bank statements to confirm completeness of bank accounts? I think there's a degree in which you can place reliance on that. It will tell you about the accounts where interest was earned. But if there is another transactional account, like a check account type of thing, then it is possible that that other check account might not have interest on. And so then the IT3B tax certificate may not actually include that account, right? So you could use that as in addition to it. It could also be that you probably look at those to confirm interest that's earned or due to the client for example, those call accounts. So that could be nice as well. Just bear in mind that you also need to take into consideration the fact that there could still be other accounts. Okay. And so just the IT3B may not be sufficient. Good. Then cash book testing. All right, so what is cash book testing? Let's just think about that also. Now, before we think about the cash book testing, let's just know that it's not always required. Okay, before we say what exactly we're going to do, but if we get to a point where debtors payments, so where the debtors, the trade receivables are paying the client, those payments are traced to the cash book in the trade receivables section, and we can see that the payments to trade payables are actually traced to the payable section, we will basically know that the transactions recorded in the cash book are correctly allocated to the trade receivables, to trade payables, and so forth. So we want to know that the processing that gets done from the bank statement to the cash book is done appropriately, whether that is a payment received by the client or whether that is a payment made by the client. So how would we test this normally? Normally we will, if we cannot rely on other procedures already performed, we would then basically select a sample of the payments and received in the cash book, and we will go and, using the selection methodology of the firm, we will then go and select those payments and trace them and check that the supporting documents, such as the invoices, etc., agree to them. Right. So that's the important thing. Firstly, select a sample of the payments made made and received, so a sample of the records in the cash book, and then go and trace them to supporting documents to show that this really did involve money. It was cash. Right. Important that your documentation, your working papers, should cover the source from where did you select this, and this will always be the cash book, because we're trying to test that the cash book processing was correctly treated going forward in the accounting process. We will document the sample that we selected, how we selected them, the selection method, identifying characteristics of the cash book entry. Remember, each of those need to be identifiable by another auditor. Right, so that's important. And then sufficient detail to also understand what was done. How far did you take this? What evidence did you actually get? So this could sometimes be necessary. And I want to reiterate that even though it might appear in your basic work program on cash and cash equivalents, because it's part of, let's call it the skeleton procedures, remember that if it is not always a required procedure, in the sense that you don't always have to perform exactly that procedure if other evidence, like your debtors payments and your creditors payments, are already sufficiently testing the cash book. Right. So that was just a thought about that point. I did see some movement on the questions, but it looks like all questions are answered, so that's all good. Right, now I want to go to, hang on, I see here, there's another question. Is it right to assume that all credit balances in the bank statements be treated as income? As such, they should be traceable to the revenue account? I'm not sure that I would necessarily just always assume that all credit balances in the bank statements should be treated as income. It could also be that they might just actually be reverses of things that happened on the bank, of payments that were made. Let's say, for example, a payment that went through that was, maybe there was a correction of an error. A very probably silly example now is I use my like e-bucks and the rewards and whatever it is in my bank. I use those rewards to pay my bank fees. So every few months, I actually get a credit to my bank statement, which is literally reversing the bank charges, because they're using those rewards, e-bucks, dividends, whatever it is called. So I wouldn't just always assume that a credit is always income. It might actually just be a reversal of something. Right. So, of course, this is probably a relatively small amount in the bigger scheme of things, but I wouldn't just by default assume that. Of course, you'll always go and ask a question to the client to also confirm that. Good. Right, ladies and gentlemen, I want you to then please go and open your caseware file. Okay, here's an interesting question. Does it mean that when I look at the work program, I do not have to perform all the procedures in my work program? All right, so this is one of those short questions with long answers. So what is firstly important is to remember that when we moved over in 2021 or 2, then the methodology changed, in the sense that before we always had all procedures show, in Probe at least. I think it was never that case in Audit International, but in Probe, the procedures all showed. And as the procedures all showed, you could basically start doing the work. When I said we're going on an audit on Monday, and you guys are all going to be part of my team, we'd rock up there and I would start the planning only on Monday morning. As long as I had a rolled forward file and I had the trial balance imported, we could rock and roll and you could start auditing. I might have to give you materiality, but other than that, the work program was there. The risk was then that we might have later on realized, actually now Susie went ahead and she audited and did all of these procedures, but actually now we see it's not really necessary to have done that, etc. It was a waste of time, but you know what? The procedures were all there. We all felt warm and fuzzy and comfortable. We at least, we might have had too much audit evidence, but hey, at least we didn't have too little. That's okay. But of course, what does that mean? It meant we spent time and energy, and what is time? Time is money, where we didn't have to, because we didn't need to address a risk. With the change of ISA 315, which was revised in 2019, effective end of 2021, then we change the methodology to say you only need to do work where you have risks or where you need to address material accounts. And so by default, you will only have procedures appear in your work program where you have recorded and identified risks. Now, to get to your question's answer. When I then record a risk, let's say, for example, in cash in bank, we had a risk for existence or occurrence or accuracy or something. Especially when I activate accuracy valuation allocation, or AVA, when I activate that risk, all the procedures that are linked to the AVA group of assertions will be activated in my work program. But the standards say I only have to perform work procedures to respond to the risk identified. So if we take AVA, for example, as a group of assertions, included in AVA is accuracy of the class of transaction. It is valuation allocation of the account balance. Okay. It is accuracy of the disclosures. It is classification. Don't forget classification. It's one of my favorites, right? We have now moved the cutoff out. That's a separate assertion. But it is important to know that I think your presentation's also got its own one. But it's important to know that classification, accuracy, and valuation allocation at year end, those three assertions all have procedures addressed. And so it's possible that I won't need all of the procedures that are activated just by me recording one risk for one of the three categories of those assertions. So yes, it means that I don't necessarily have to perform all the procedures that appear in my work program when I record a risk. I only have to respond to the actual risk recorded. What I will say, though, is that a lot of firms do restrict the functionality in the software for very junior staff members to say, please don't just go and edit or record or change procedures yourself automatically. Use the guidance of a senior, a manager, a supervisor, someone in the team. So yes, that is what the methodology is set out to do. It provides you with some examples of procedures, but because it's just software, it's if formulas. It says if AVA is ticked, switch on this procedure, or if completeness is a risk, switch on this procedure. But you still need to go and apply a professional judgment to determine whether these procedures are actually required for you to address the risk that you've identified. Okay, so basically the appropriateness, is it really necessary? Be careful of just going, almost want to say, too rough with that, too brave and cut out too many. There are some procedures that are actually listed that will always appear, like, for example, the procedures around accuracy and completeness of procedures of work information provided by the client, that will always appear, because whenever you work with client information, you need to confirm the accuracy and the completeness of client prepared information. Right, I trust that will address it sufficiently. Right, so in our case file, you may remember that we did in the first session also go through the pre-engagement documents. So your documents might have looked slightly different in pre-engagement planning, etc., maybe slightly different folders, whether you are using Probe or Audit International. On my case file, we're going to work through Probe Audit, and then when we get to signing off the work program, I'm going to give Samu an opportunity to also show you what the Audit International work program looks like. So if your documents here look slightly different, we're not worried about them. We're not going to work on them. We are going to work in the actual working papers, the Excel documents and the PDFs from the client. So you are able to follow along whether you are using Probe Audit or Audit International. When we get to signing off the work program after the completion of the work, then we will show you both of them. All right, so please don't feel now, oh, your file looks different to mine. What now? We are going to show you the Audit International version as well. All right, but just to orientate ourselves, we were busy or not busy. We don't have to look at the audit planning. The planning was done for us. What we need to go to is where the lead sheets and work programs are. We go to section 420, which is where cash and cash equivalence is. And we will then go and just have a look quickly at what was done here. So there was an system description. We're not going to look at that today, but there is a system description that was added. We are going to look at the bank reconciliations working paper. You will see that, if I remember correctly, it's now long ago that I need to think about. Before, in the blank file, we had that one in there, but we'd already worked in and on it in the work, in the session, in the recorded sessions. So that's already halfway completed, probably. Then we had added the client's 2 bank accounts, and we've got the disclosure working paper. So I'm not even opening the work program right now. We are still auditing the section. So if you are able to follow along, please open up 421, which is in the bank reconciliations working paper, where we are going to audit the last account that has not been addressed yet. Right, so again, just to touch base and see where are we, what's been done. So this is working paper 421. Our client, or rather our firm's template is being used, Fletcher Inc. The client is Wrap Up Manufacturing. We've got the year end. We've got the materialities listed there. The risks that we are addressing for AVA, accuracy, valuation, allocation, we've got a medium risk, and the other 2 assertions, rights and obligations, and existence and occurrence is low, as per the risk assessment. Right. We are selecting all the bank accounts, so selection is 100%. There was no sampling involved. The work program, we will go and sign off step 3 later on, but that's what we're going to do in this section. So we have already looked at 2 of the accounts. We are now going to look at the third account. The third account, if we go to our lead schedule, let me open up the lead schedule. There we go, 420. Sorry, I'm looking at it and not seeing it. If we open up 420, we will notice that we've got the call account and the current account. That's already on the working paper. But last year, there was an overdraft facility with a positive balance last year. And this year, it is a credit and negative balance. So you can already see it's completely zero this year. But of course, zero doesn't necessarily promise us that there's nothing. If we go and we look at the what's the word now? My words are leaving me. The bank overdraft section, the current liability section. That's the word I'm looking for. In the bank overdraft, there's a lead 620, right? So they're quite nicely numbered, 420, 620. In the bank overdraft lead schedule 620, that is where we will find the balance for the net bank overdraft facility for this year, 3179265. So we've already, in the recorded part of the session, we considered, is this sufficient? Is it appropriate that we are considering this as part of cash and cash equivalents? We said, yes, it goes positive, negative. It flips between the different years. This is part of cash and cash equivalents. So we are comfortable with that. It's not a long-term loan. It is, in fact, really part of our cash and cash equivalents. And we are now going to do the bank recon audit, or audit the bank reconciliation for this overdraft facility. All right, so let's go back to the Excel then. I'm going to just split my screen so that I don't have to go flip between the different parts all the time. So can you still remember how to do that? To split my screen in two and see one half in one side and one half on the other side, I'll use the little window button on my keyboard. So I'm going to hold in the window button on my keyboard and press left, which will then basically take this one to the left half of my screen. So if I do that, my goodness, now I didn't take the Excel one. Can you believe that? It does that sometimes, eh? So let me just, okay, there we go. That's the left one that I want there. And actually, I'm just going to create the lead schedules on the right-hand side. So how did I do the one on the right-hand side? Windows arrow, Windows, and press the right arrow. The Windows button on my keyboard, press the right arrow. To do the Excel one that I moved to my left in this case, press the Windows button and move to the left. Okay, good. So what are we going to do for this one? Well, we're going to record the account. That's what we've done before as well. So if I then look at the client's actual general ledger account, that's the 5410 net bank overdraft facility. That's what we're going to record there. Why? Because this is the balance per the cash book. Okay. So the balance per the cash book, let me just focus when I'm typing also, net bank overdraft facility. And now remember, this balance is not a positive like the other two. So remember your minus there. 3179265.38. That's exactly what we have in the lead schedule. And did we agree this to the lead schedule? Yes, we did. In this case, you can see also there that my reference is also to the lead schedule of 620. So if you are using the font for Webdings, so if in my case, you can see I'm using the Webdings font, that means that if I press a little A, it's going to make the little tick mark. Okay? Just say, yes, this has been done. And because we've already done it, I'm quite sure, but I'll show you again, that we already have our legend updated to say no exceptions noted. So yes, the lead schedule balances, or the balance agrees to the lead schedule. All right. These would be if we had any reconciling items. We're not there yet. We are then going to go to the balance per the bank statement that was obtained from the client's reconciliation. Where do we get this? Right. So we are going to go to the let me just show you this one. So in the cash and cash equivalent section, in your material that you've downloaded as a delegate, you will have a folder called supporting documents. And there are a number of documents. I didn't download all the documents. Some of them were used in our recording. So they are those ones we've already used. The client prepared bank reconciliations is something that we are going to use there. So we are going to just open that one to see that's the reconciliation that the client has prepared. All right, again, I'm going to just split it to the right-hand side. Yes, the Excel is still there. So this is the current account one, the first one that we did, the net bank call account. This is the one that we are going to look at now. Now, what are you noticing here? You can type in the questions if you want, but I'm noticing something with this last reconciliation. It's a similar balance to what we have, but what are we noticing? Well, I'm seeing this one is called the Nedbank discounting facility. Yet on the trial balance, on the lead schedule, the client is calling it the overdraft facility. Let's see there, overdraft facility. So we'll need to go and confirm and see what is this really about. Now, also in our facilities letter, we will also see that it is the overdraft facility. So let's assume then we go and we ask the client, why is this called discounting facility? And they realize that they've actually just made a mistake in the response or in the wording on their template, and that this is then actually the overdraft facility. All right, that is also thankfully what they called it in the trial balance. So that looks better. So this is then hopefully just an error on the client side. We'll go and check definitely what does the bank statement say for the client. Is it a discounting facility or is it really just an overdraft? Check the terms, etc., to confirm that this is really just I want to say a human error in terms of the matter. Okay, don't just assume it. The client just says yes, okay, and there you go along. No, please not. But that then probably then human error in this case, after we've confirmed and corroborated. Good. So that was then the balance per the cash book. That was the 3179 that we've already recorded in the Excel. We agreed it to the lead schedule, so we are comfortable with that. And we then recording now the balance per the bank statement, which on the client's reconciliation is then recorded as 3166233. All right. So again, remember the balance is negative. So start with your minus 3166233.52, right? That's the balance. And now they are saying this is per the bank statement. So we need to go and check the bank statement itself to confirm that that is in fact the balance. So we'll go back to our supporting documents, go to the folder, overdraft facility bank statement, and open that and see what is the balance at your end according to the bank statement for this client. Okay. If you hear me keeping quiet, I am taking a lot of water breaks today. I don't know why, but I feel very thirsty. I don't know if it's the bank cash and cash equivalents that's making me thirsty, but anyway, maybe it's the fact that we are in overdraft. Good. So this bank balance, there we can see at the end of April, 30 April 2023, the balance brought forward is listed there. Now let's just see what we've got on the working paper. So that agrees 3166233.52. So again, check the bank statement. It is in the name of Wrap Up Manufacturing. It is in fact the account number that says bank overdraft. That's the statement number, so that doesn't make so much of a difference. We can even check the bank account number if they give that to us somewhere, but we can see the date, the client's name, the bank overdraft, and the balance. All right, so we are comfortable that we have also agreed that. Now, you can, of course, see that there's a difference. If I just scroll out a little bit, there's a difference between the balance on the bank statement and the balance on the, on the cash book and the bank statement. And to a degree, we already know what the difference is, because if we look at the client's bank reconciliation, they have listed interest and fees for April 2023. They've listed two different lines. Now, if I was to go, I'm just going to actually split these two PDFs so that we can look at them next to each other. If I look at these two amounts and I actually look at the three lines that were processed on the bank statement on the 1st of May, I can see that there are three amounts processed on the 1st of May, and that will then ultimately get me to 3179265, which is the balance in the trial balance. So these three things are then making up the difference. And we can always go and take Excel, take your calculator, go and open my calculator. Go and actually just cast those three items, and you might have fancier software that can actually cast those three things, but for the sake of us just seeing what's been happening, I'm going to actually just say, right, 1183.50. Because I started with a positive, I'm going to carry on, plus 7890 plus 3958.36. And the total of those three gives me 13031. If I do something similar on this side, well, I could have just gone with 3985, which is that last one, and then the total of the first two, it also shows me the 9073. So I know that this 13,000 on the reconciliation and the 13,000 for these three line items, that is what makes up, oh my goodness gracious me, that is what makes up the difference for my recon. Okay, my highlighting is not so lacquer today. Good. Now that we know what makes up those three amounts, let's go and consider whether those are actually in fact relating to the client in the financial year that we are auditing? So in other words, should they have been recorded, or are they only applicable to the next year? So overdraft fee, that is the fee that the client pays, basically in reverse, to say you had a facility of an overdraft in the last month. I'm charging you now for that. So that is a charge after the fact. So we have to record that in April already. How will I know that? Well, I can also go and see for how long did they have it and when did they normally record for it. If they had the overdraft for all 12 months of the financial year, but they only have that fee recorded 11 times, then I know we still need the 12th one. Okay, so it's not necessarily just because I'm telling you so, but also you will go and see for how many months did you have the overdraft fee, and do you have all 12 of those months or all of those months accounts in there. You can also check the terms and conditions of the client, but because it's charged on the first of the month, I believe it's safe to say that that was charged after the fact, for the fact that you've already had it. The service fee then, also quite an amount charged because you had the access to the facility. And the other thing that also tells me we need to record this is the interest that you are paying on the amount outstanding for the past month, that 3958. All right, so we are going to include all three of those. We are comfortable. We've confirmed them to an external, independent, objective document. Those are the three amounts that make up the difference between the balances. What do we need to remember? The money that was actually in the bank account at year end, when the clock struck 12 o'clock on the 30th of April, was 3166. But how much money was really ours at year end was 3179. It's even less. So how much money did we owe, rather, was even more, because those fees hadn't been recorded yet. So if we go back to our Excel, that will then make up the difference for our reconciling items. Now, what you could do is you could also say 3197 minus the 3166, and that will show you the difference. Or if you wanted to, you could go and cast those items in there as well. The description here is interest and fees for April 2023, which of course is still a month in our financial year. And what did we do to audit this, to confirm this? We agreed amounts to the bank statement, transactions dated 1/5/2023 on the bank statement. These fees, however, are appropriately raised as they relate to the use of the facility. I must concentrate when I'm typing facility during the financial year, April 2023. Okay, so there I'm documenting. What did I do? Have I applied my professional judgment? Does this make sense? Is it correct that there is this reconciling item, or should something be done about it? And then we can also copy and paste the cross cost, because we know that the minus 3.179 and then the interest and the fees does in fact give me the 3166. I guess this should actually be a positive, because that makes up the difference. All right, the reference. Where will we see this balance 3166233 in our engagement file? Well, currently there's nothing in our file yet. If I go back to my Caseware file, let me show you the Caseware file. Caseware file, where are you? In my document manager. So there's nothing here with reference to the overdraft. So most of the time with something like this, where the document, or the balance rather, is part of cash and cash equivalents, we will simply refer the lead schedule, or reference the lead schedule, to the work done in cash and cash equivalents, because already our reconciliation working paper is here. But we do now need the statement for the overdraft in this section. So again, back to our supporting documents. So in our supporting documents, what we will now do is we will actually copy and paste, or drag and drop, the bank overdraft facility statement into our Caseware file as part of our evidence. So I'm literally going to select the item in my folder, drag it. What makes most sense to me is to drag it just below the other bank statement, but it's up to you as to how you want to do it, and to actually then have it listed there. So automatically Caseware goes and gives it the next number. So 422, 423, 424 are our 4 bank statements. I'm going to right click and edit, or right click and click on properties to change the word, because here in our supporting documents, it was very convenient to have them numbered for our course purposes, but I don't want a random 4 there in the document name in my audit file. So clicking audit properties, not audit properties, sorry guys, document properties, I can go and change the name of the document to remove the 4 in the name. In the location, I'll probably also change it just so that it looks nicer. It's not going to make any difference. What is important though is that when you are pasting any of these PDF documents in your client's file and you want it to be a document on which you can work, treat it as a working paper with the same functionality as basically as a lead schedule. So in that functionality of a lead schedule, you can add, you can reference, you can include links, hyperlinks to other documents, references to other documents. That's what we want to do in our on this bank statement, to be able to actually document evidence for it. So I don't want to have it as an external viewer PDF document that's basically just a PDF. I can't do anything with it. I want to have the information from the PDF there, but I want to actually then make it so-called internal viewer so that it looks like a working paper. So that's important. If yours does not say internal viewer, make sure that you do it as internal viewer. Right, that will then change the properties. It asks me if I want to rename the file on the disk. Basically, what I've said is that the location mustn't say for So if I want to go look for it in the Windows, it will actually now have a different name. That's exactly what I wanted to do, because I don't want it to say for Netbank Overdraft. I wanted to just say Netbank Overdraft. So yes, I'm going to click yes. I'm going to rename this document. That's now part of my audit evidence file. If I now open up 424, this is the statement. But what happened now? Can you see that we've got the client's name at the top, the year end, as well as a section or working paper name? And I could even then go and add, at the bottom, it's also got my working paper references and stuff. And I now have the function, the ability to add references and links and things to this work program. Right. So, sorry, not work program, working paper. It's now like a working paper and I have functionality. So I want to now actually include a reference in my working paper to say, go and have a look at document 424, because 424, hang on, I just definitely don't want it to be a number. Maybe have it as general or something like that. Or if you want to have it as number, then I just do not want it to have any decimals, because we're not talking figures here, we are talking document number. Right, so that's what I'm going to have there. How will I then reference it? I will then go and include a reference in my working paper to include a reference. So let me just show you carefully. I can add a manual reference, but I prefer to have an actual like a hyperlink reference. So I'm going to actually include a hyperlink reference on my working paper to say, go and have a look. Engagement working papers, lead schedules, current assets, because we are working in the cash and cash equivalents. Okay, there we can see the working paper. I'm not going to reference to that, but I can reference it to the bank reconciliations working paper, which is what we've got on the left-hand side. Okay. If your policy is rather to reference everything back to the lead schedule, you can do that as well. That would be 420. So in my case, I'm going to reference it to the reconciliations working paper. From the reconciliations, we'll reference it to the lead schedule. But the point is just to show you how to include a reference. So it just takes it up there to the top. So I'm going to now just drag it to where I want it to be. There we go. There's my reference to the working paper 421, and someone can now follow that link. Right. So we've referenced the balance per the bank statement to the actual bank statement. Now we can go and complete the documentation. Have we agreed the balance per the bank statement to this working paper? Yes, I have. And you will see there, I've just put in a little A. Because it is in Web Things, that makes a little tick mark. Does the bank statement, is the bank statement in the name of the company? Yes, it is. We've already checked for that by saying wrap up is in fact, and you could, if you desperately wanted to, you can actually even highlight that. And let me just do it a bit better this time. Have it like that. And there it is then highlighted for you to see. Right. And then bank statement in the company name. Any misstatements identified? No, none. So I'm just going to put a 0 in there. Then we all know it has been completed. I didn't forget to complete it. I can see the 0. Right. Good. So that is then checking the reconciliation of the Netbank overdraft facility in that case. Good. I'm going to close this working paper now. That working paper's there. I can even sign it off then, I guess, by saying performed by. That's signed off there. Good, but now we still need to see what's happening in this working paper in terms of our overall work and our conclusion. So what we see is that in our first expense, we had a problem, sorry, not expense. What we see is in our first bank account, our current account, we had a problem where we had identified that 151,000 Rand of creditors were processed as payments made. But the money at year end had not yet left our bank statements. So they only left our bank statement, our bank account on the 3rd of May. This used to be quite an often an issue when we still used to have checks, where you'd write out the check and weeks would go by before that check was actually ever settled and the money actually left your account. So that doesn't happen anymore. But with EFTs, where you are transferring payments, you might already have someone processing the payment today, but the money only actually leaves your account tomorrow, or maybe the one person approving it, but the last one like releasing it, something like that is often just a short timing difference that has the difference between when does the cash book actually process that payment, when do we believe the money has gone, or when do we process that it has been paid, and when does it actually leave your bank account. Okay, so that was really, it's like a timing difference. That's all it is. But strictly speaking, really strictly speaking, if you go and have a look at this and you say, what was really the balance of the bank account at your end? Then if you really go look at that 151,000 Rand was still in the bank account at 12 o'clock on the midnight of the changeover between 30 April and 1 May 2023. So what this says is, strictly speaking, the bank account balance was showing 151,000 Rand too little. There was actually 151,000 Rand more, and there was 151,000 Rand more creditors owed. So your bank balance is showing a little bit too little money, and your creditors are showing a little bit too little. So strictly speaking, again, you should actually be fixing that so that we can have it corrected. That's the one. The good news is it is still not material. So if we look again at the performance materiality, it's far from performance materiality. So it is small enough that we can just put it on our schedule of order differences. The client might never even actually change it. Only really when it gets material will a client probably be more inclined to change it. But we will still record that as an entry, an unadjusted proposed journal entry. So it's factual, but we don't have to, I almost want to use the word force the client to fix it. That sounds bad. But it's not something where we need to really go and try and convince the client to fix it. We will ask the client, in terms of the standards, they say the policy or the approach is to say, this is our list of order differences, please fix those. And then the client will say, well, this one is just the timing difference, I'm not going to fix it. And we need to determine whether that's materially mistaking the misstatements, the financial statements at your end or not. And we conclude it's not. Right. For the net bank call account, there we had a difference of almost 700. And that was really, again, a timing difference, but in this case it was because of interest that had to be accounted for, and that was not accounted for, only capitalized when it was paid for into the account. So here we are going to actually account for a journal entry. I'm going to make note 1, and note 1 we will just document there. I'm going to write the journal entry for you. And then because we do also write it on our working paper, and then when we get to the caseware functionality, the journal's already accounted for or included in your caseware file. So you don't have to worry then about that not being done. So I'll do it here a little bit more slowly, and then you can see where it is accounted for in your caseware journal entries already. All right, so I'm going to just say creditors, payments processed should be reversed, and interest should have been capitalized. Journal entry should therefore be debit. And now you'll go and look for your account numbers. In this case, what are we reducing for the creditors that went through? Well, we have to actually make the bank balance a bit more, and the bank balance is 8450. That's the account that we need to make a little bit more. So I'm just going to put through that account from the general ledger. The current account, that's what we're going to debit to make the balance more. The amount that we're going to get is the amount of those creditors that were only paid after year end, or where the money only left on accounts after year end. The debit, that's the account payable. So if I go back to wrap up and I go look for what are the trade payables balance, well, that will be on my trade payables lead schedule. And that, we go look at the trade payables. There we have the accounts payable account 9,000 000. Right. So that's the balance that will get credited, and we will do that 9,000 000. Oh, no, triple. And we say accounts payable. And of course, that then is the minus 151,370.59, or you can just say minus the previous balance. That is for the, almost want to say the first error, the first issue, the creditors that were paid but didn't show the amount leaving our bank account at year end. Then the interest that was only recorded in the new year or in the new financial year or the new month, for that one, we are going to say again that should have increased the bank balance because this is the call account. When we get that interest, it increases the balance. So also in this case, we should have debited the bank account, but in this case, it's the call account. So that's the next line, the second line, net bank. Oh my goodness, net bank call account. And the balance, I'm just going to take, I almost want to say a shortcut, just take that amount, that will then pull it through. And the credit will now be my interest. And the interest, to find what the interest balance is going to be, I'm going to go to the income statement. Now, I've completely forgotten which lead this will be on. I think it's operating income. 27, no. Oh, I see now. It's interest received. That's fine. Investment income. Sorry, guys. Blank moment there. 2750 interest received. So that's the account. All right. So 2750, and that's also 000, and that's interest received. And then that is a credit. So my journal explanation is the creditors' payments that should be reversed, the interest that should be capitalized, and there is my debits and my credits. What I can then also do is just basically to refer to, and then I will include my journal number. Okay. I'm not going to update it now because I'm going to show you where we will get this number once we have done that. So this is now my working paper where I can conclude and say I am going to process a journal as an unadjusted order difference or an overs and unders journal, some of you might refer to. Let's go back to caseware and go and see where that needs to be processed. So in my caseware, sorry, that's case view. Back in my document manager, I will now, let me just show you that still. Sorry, I'm jumping around. I will now go to my adjusting entries right at the top. And as part of your caseware working papers, e-learning modules, you'll probably already have seen or somewhere you are going to see about adjusting entries. I'm going to process an adjusting journal entry to basically tell the caseware software how the client's trial balance that we imported must be changed. Right, let's see. So there's already a journal entry called HM1 that's already been accounted for. So you can just select that one. That's the one that's already been processed for you, and we're going to see how that has been recorded. So it was a yearly type of journal entry, which really just means at the end of the year. It's not a monthly thing. It's not processed in a specific month. It is at the end of the year. The date is at the end of the year. The reference is the working paper reference, which you could just type in, but you can also, if you want to, literally use the drop down to go and select the relevant document where this comes from. So you can choose what is your best functionality. In terms of the types of journal entry that you are processing, if it was a normal adjusting, you are fixing the client's trial balance, you are changing the numbers, you would have chosen normal adjusting. If it was reclassifying, so in other words, it's not, the building is not property, it is actually investment property, that kind of classification, you're just changing where it goes, that would have been that. And then your unrecorded are your changes where you are not actually changing the trial balance, but there's a mistake. We want to record the list of audit differences. So in this case, we know these things are wrong. There's a factual misstatement or a factual difference. Projected and judgmental, those ones we had spoken about in the first session. So I'm just going to record a factual one. It goes through the financials. I don't need to worry too much about the others. There's my whole long process to say, if anybody else needs to look at this, how am I going to explain this? To say creditors payments processed before year end, which only went through the bank account after year end, should be reversed. And the interest relating to the current year should have been capitalized. Doesn't happen again and again and again. So there's no recurrence. And those are the same bank accounts that we have recorded in our Excel working paper. And then with the same amounts, everything. And I had recorded that one. Okay, so that's already recorded. Where will you see this? If you are in your finalization stages, any of those, that's where we're going to see all the schedule of audit differences and specifically then the unrecorded differences. Because if I go to my lead schedule now, this, let's say, for example, so both of these would have changed my cash and cash equivalents balances. But you can see that my call account and my current account, in the adjustments column, there's nothing there. We did not record it. It's an unadjusted difference. So yes, it's a proposed difference. If differences become material, if the client really wants to, they can change it, that we can process those journals. But for now, they're not being processed. They're not actually done. We are just listing them as order differences, unadjusted schedule of order differences, overs and unders. All right, so that's now where I can now come and say refer to HM1 because that was the journal entry that we had recorded, just to show you there again. Now, your firm will have policies of how they number the journal entries. In our case, the journal entries are numbered HM1 because our pretend firm, imaginary firm, said you will use your first letter of your name and your surname or your initials, and then start numbering 1, 2, 3, 4, 5. So this journal entry was processed by Helen Miller, so that's HM1. If it was me, it would be Johanna Schreder. J is 1, 2, 3, 4, 5. Then we know who processed it. All right, so that's just our firm's approach. Your firm may have something else. Please follow your firm's approach and how you process those, but at least then now you know how and where these are then processed. Good. So that then is the cash and cash equivalents and the bank section. Now, I want us to just then go and sign off the work procedures in the work program. I'm going to close the working papers for us and go to the work program. Now, as a reminder, what I'm showing you right this minute now is the work program in the probe audit methodology. After I've done that, then Samu is going to also just show you what it looks like in the Audit International. So just hang tight, see the difference between the two. I also think it's quite interesting to see where the similarities are. So please don't just switch off because I'm doing it now. The concepts apply equally to both methodologies. So we started with the risk assessment. You can see again here we had a medium risk for AVA, which then increased the risk overall. Materiality is there. These are the risks that we recorded for our sections. Bank accounts recorded in the accounting records may not actually exist. We've tested that. Cutoff, we tested somewhere else. Not all bank accounts were recorded, so that was the completeness. We didn't actually test the completeness now, but we could have looked at that. Securities provided to the bank may not be appropriately disclosed in the financials, so we'll consider that. And then bank accounts may not be in the name of the company. So rights and obligations, we've checked that when we did the bank reconciliation. So the risks have been addressed if we just look at it overall. The procedures that were then recorded, and already Helen's done a lot of the work for us, so you'll see that a lot of the items have been signed off. That's where we spoke about the bank overdrafts, whether it's cash and cash equivalents. We inspected the list of cash and cash equivalents and confirmed that the financial assets and liabilities are set off as allowed by IFRS for SME. We can also have a look at that later when we look at the financials. In terms of the bank reconciliation, what did we do there? We checked the costs and cross costs, and now we need to sign off the work program. So exceptions, if we performed the procedures and we find an issue, let's say like the creditors or there was the costing had an error, any of those things, but we've dealt with it, we've processed the entries, it's not material, it's clearly trouble, then we can say no exceptions noted. So exceptions, no, and we sign off the work procedure, and then it will show today's date and my name. So my user that I'm logged in as shows Larisha Governor. You only say yes where there is an error or an issue on the file that you cannot basically, it's almost like preventing you from going anywhere. So it's an issue that is such that you're going to have to adjust your audit opinion, or amend your audit opinion, or the partner needs to go speak to the client, something like that. Okay. We've agreed the balances in the reconciliation statement to the lead schedule. Yes, we did that. We agreed the balances in the reconciliation statement to the bank statement. Yes, we did that. Sorry, now you see I'm saying yes, yes, yes. We are saying, were there any exceptions? No, there were no exceptions. Just want to give the script a moment to run. I'm going to do the same thing there. In terms of agreeing the balances, we ensured that the bank statement is in the name of the company. That's good. You know that you can also, when you're signing these off, you can literally just click on that field and say N. Just type the first letter N for no, and it will sign off already. Okay, so it's almost like an Excel where it picks up what the drop down is. And then inspect the bank statement after year end. Ensure that all transactions that should have been recorded after year end have been recorded. We already confirmed that through the bank statement as well. Follow reconciling items to the underlying documentation to ensure they are recorded in the correct period. And that's all ready to be signed off. Then Helen also obtained the facilities letter for us. We can have a quick look at the facilities letter. Just want to give this some time, right? So she said she inspected the facilities letter and the banking system for additional accounts. She's comfortable that there are no other accounts. However, in looking at the facilities, we need to check that the bank statements, inspect the financial statements for appropriate disclosure in line with IFRS for SME of these facilities. So I'm not going to do the part about the minutes now, but that Helen will do for us as well in terms of the minutes and check whether any of these are done. But let's just quickly have a look at the facilities letter. So we've got the facilities letter, a redacted one, number 5 as the working paper, and then we also have the accounting policy and note. So you can open number 5 and 6 for me. That's number 5, and I'm going to open number 6 as well. Right, so on the left-hand side of our screen now, we are seeing the notes to the financial statements. Note this is the draft financial statements. And in this case, we can see that the cash on hand, the bank balance, the overdraft, they're all there. They are separately shown. The current assets and the current liabilities are not set off against each other. They are appropriately disclosed. In terms of our facilities, here we have the you can also import this if it's your firm's policy. You can also import this into your file, make it one of those internal view documents. You can highlight then the fact that the securities are a session of the debtors book, etc. You can link it with a reference, but because this is not just an Excel that I opened out, you can't do the same. But very similar to what we did with a bank statement, you can do that here as well. Right. So looking at this, it is disclosed appropriately. The facilities have the necessary notes there. It is not set off incorrectly, but it is in fact disclosed and recorded in terms of IFRS for SME. So we can then also sign off step 5 to say we are comfortable that the facilities are disclosed in terms of IFRS for SME. All right, I'm not going to look at the rest of the work program. I want to give Samu an opportunity to also just show us what it looks like on the Audit International side. So I'm going to hand over now to Samu. If there are any questions, of course, please send them our way. And I'll also look for them, but I'm going to just make Samu presenter so that she can show us what it looks like on the Audit International side as well.
Thank you very much, Yane. That was a good presentation there. Okay. So I just want to take you through the Audit International, and we go through how do we now document our work in using the Audit International template. I will also show you more technology that applies to actually both sides, which is your probe and your Audit International template, okay? So first thing I would like us to note in Audit International is that the procedures for bank reconciliations are covered in 2 documents. So right now, you'll see that we have document 420.10, which are your cash and cash equivalence audit procedures. Then we further have document 420.12, which covers other procedures. So it's bank reconciliation procedures as well. Okay. Let us now just see how the 2 work together. So your main audit program is the cash and cash equivalents. Let's just double click on it. All right, you'll see just like Ioane was showing you on the probe side, we do have your risk assessment that shows at the beginning of your audit program. That comes from your planning. So your audit seniors would have covered that part. Also, we have the procedures that have been added to your file. You will find them already there because your seniors would have done that for you. For more details on how that is done, like in planning, we'll be covering that in level 2 sessions. Okay, but what you will find is as a level 1 attendee, or let's say a junior auditor or a trainee, you will only just find this part already completed. Okay. Now covering so the first part has already been covered from the recording that we had given you. And my focus today is the bank reconciliation, which is the exercise that we just completed. Okay. So bank reconciliations in this document is covered in procedure number 4. So in procedure number 4, you will see there that there's a procedure that you can complete. So you can select here whether it was completed without any exceptions, completed with exceptions, and you note them here in your blue sections here. This is where you will note them and you will sign off and create the references. Referencing is something as well that you would have covered in the recording if you did go through the recording. And if you want more information on how the referencing is done, you will see it in the recording. What I would like us to note though is that in your procedure, there's a further guidance here saying consider using document 420.12 to perform the procedures contained in the form. Okay, so this is how now the main document, which is 420.12. This is how this audit program links to 420.12 now, which is the procedures specifically speaking to the bank reconciliations. Okay. This number, the document number here, since it's blue, it's not only a number, but it further serves as a link to that document. So to access that document or to navigate to document 420.12, it's either you go back to your caseware file and click 420.12, or conveniently, you just go to the link, so the number of the document here, which is the link to the document, and click on it. It's going to launch the document 420.12. Okay, then in 420.12, again, you're going to be completing and saying, okay, we did, again, referring to this exercise that Joanne just did with us, which is we did agree the opening bank statement to the bank recon. You will say that, okay, that was completed without exceptions. Or you say, maybe if it has an exception in one of the notes, you say, in one of the procedures, you say this was completed with exception, and you note the exception there on your green background cell here. Then you can sign off, right? I would just like us to take this moment to further dive into understanding the process of responding to the audit procedures and signing them off. Okay. Let me just go to the previous document for this exercise, right? So now we're just looking at the technology, right? So to protect the integrity of the audit work that you had performed, we have a control in our technology that protects all the procedures that have already been signed off. You will note that, for instance, procedure number 3 is the listing. It's already been signed off by Sandrine in the 2024 session. If I can, let's say I need to edit something in this procedure, you'll see that I have no rights. You will see even on your side, if you have a procedure that is already signed off and you try to edit it, you cannot edit it, because we are protecting the integrity of the signed off procedures and your documentation, right? But if maybe your manager raised a review note, or you noticed that maybe you made a spelling error, you can go back and edit the procedure. So that's an exercise that I did with procedure number 2. For procedure number 2, I went back, I deselected the sign off like this, and it became a green background like this again, right? And I edited my response. Let's say, for instance, my manager came back to me and said, Samo, I see that you completed procedure number 2, but I just want us to put more detail in now our response here in documenting the results that we got in this procedure, right? So I've done that. Then, so I had to go deselect yes and change the response, then sign off. So now I'm signing off here with you. One thing you will notice is that the moment I sign off, the date is now today's date. So this procedure was performed on the 7th of March. Oh, not this one. This one we just performed. So procedure number 2 was initially performed on the 1st of March 2024, right? And what I'm doing is I just went back here, not because I performed further work today, but just because there's a wording that I had to go and change, right? And I signed off. But now there's a mismatch between the sign off of me just changing my response because of a review note that I got, which has nothing linked to the audit evidence, and the response and the date of when the audit procedure was actually executed. All right. Before I show you how to correct this mismatch using our software capabilities, I want us to understand the concept of signing off. So signing off serves as an indicator of when the procedure was executed and when was the audit evidence actually obtained. Okay, but we know that practically we would at some point need to go back to our procedures and edit them. Let's say we are just improving our wording or we are doing a spelling check. So practically we might need to go and edit our responses. So to solve the mismatch that happens when you go back to change the spelling in your response, or our system does allow you to adjust the date to reflect the original date of when the evidence was obtained. And this is mainly done to ensure that everything remains accurate and your audit, like it all aligns to your audit timeline. Let me show you how then it's done. So on your sign off, there's an icon here for a calendar. When you click on it, you can go back to the date of when the evidence was actually obtained, which in our case is March 3, 2024. Right? If you change the date, again, I need you to note this. If you change the date and it doesn't alter the evidence that you obtained, or it doesn't change that you are actually obtaining, you actually had already obtained the evidence at that or executed this procedure. You are just coming here to correct the spelling or to clarify the documentation for the future users, or just making sure that the documentation is correct. Changing the date here is generally acceptable, right? So that's the only capability I just wanted to show you right now. Thank you. I can now just hand back to Ioane.
So, goodness gracious me. Firstly, again, if we think about operating expenses, we are auditing the financial statements and we are thinking about where did those operating expenses come from. Now, again, the operating expenses disclosed in the financial statements come from what is recorded in the trial balance and other matters, other places, other sources. Those come from the general ledger, or the trial balance is made up of all the entries into the general ledger. And if you think now, you are thinking telephone expense and traveling and whatever else that may be necessary. And then usually there's no subledger. Maybe for petty cash, if there's a lot of petty cash expenses or something, you might have a bulk process or a lump processing of expenses from that side. But usually there's not really a subledger for expenses, but you will have supplier invoices supporting those expenses that were incurred. And of course, before the supplier invoice, there was some kind of action, someone making a call which incurred a telephone expense, someone purchasing something, etc. All right. How is this different from employee costs? Well, we're going to look at employee costs shortly, but these are your, let's call it all your other expenses. Right. So that firstly, then just a quick reminder again that when we are auditing expenses, we are again asking ourselves, what does the financial reporting framework ask of the client? The client uses IFRS for SME. What is the principle? What is the accounting policy for IFRS for SME? And has the client applied that policy in IFRS for SME to processing of these accounts? Right. So we are going to then go to now I'm not in my document manager, we're going to go to operating expenses 750, where you have your working paper, the working papers for auditing the expenses. So you'll see the operating expenses working paper. There we go. Yes, 751, which is where we're going to look at some of the expenses. I'm going to open that, and then I think it's maybe a good time for us to just have a quick comfort break. You will see that there are a few expenses on this list. So just again to remember, we had risks for existence and occurrence, probably more occurrence because we are talking about classes of transactions, as well as accuracy and valuation. So those are the two that we are testing, the two risks that we are addressing. We have reconciled the general expenses. So what we are going to do now is we are going to just test one of the extra invoices that was not covered in the recording. All right, so we are auditing expenses. Now, just to recap what's happened up to this point, we had the general ledger, we reconciled the detailed general ledger to the trial balance. So we know that when we are looking at the working papers or supporting documents for expenses. So if I show you my information, this file here that's called operating expenses, the general ledger, we're probably going to also look at that a little bit later on. So let me open it so long for you. But we are comfortable that this general ledger account is representative, minus taking a while to open. Let's be patient. So this, what we are seeing here, is representing what we are auditing in the trial balance. And that's because we have already done the reconciliation. So you would have seen we were working on all these other ones. This is where we pulled the sample, and all of those things. That was all done as part of the recording of the session. So if you hadn't managed to get through the recording, please know that we have reconciled the general ledger to the trial balance. We know that when we are working in these general ledger accounts, we are working in the information that represents what's in the financial statements. All right. So our senior helped us to select a sample of items. This is the sample that we put on our working paper. And in the video recording, we've already worked through some of the items. What I want us to work through now is invoice number 3. So we'll see there that there's an expense that was recorded for motor vehicle for petrol and oil. The expense was on the 28th of April. We've got the invoice, we've got the amount, and now we are going to go and basically perform the procedures in the work program. I'm not going to open or show you the work program again, but basically perform the procedures to trace this expense to supporting documentation, corroborating evidence. Why? We want to make sure that this expense occurred. It did actually take place. It does relate to the client's business. It was a client expense, so not their, personal vehicles, petrol or something that they bought. Hopefully they didn't buy 61,000 rands worth of petrol or something for themselves. And that the amounts and the details are accurate. Okay, that's correctly classified. So all of those matters we want to confirm. So the procedure steps are listed in the headings for us. So let's go and see. And again, I'm going to just move my screen to the left. And then for the supporting documents, I'm going to actually then go into the invoices. So in the invoices, we have a fantastic client. When we ask the client for all the invoices, they even numbered them for us in accordance with our sample. So now we really can just go and let me just make this thing smaller because I'm using up too much space of my screen for my liking. There we go. So now we can just go and see there's invoice 3, Good Morning Oil, number 3, and that is hopefully the expense that represents the item that was recorded in the general ledger. So if we open that up and we have a look at that invoice, hopefully we will get all we need to. So again, I'm going to put this on our right-hand side, and now we can look at it, make it a little bit smaller so we can see everything on one screen, and then go from there. Good. So first of all, the amount. The amount recorded in our general ledger is the 61,575. Do we see that on the invoice? I do see it on the invoice, subtotal 61,575. Right, so that means that when we recorded this invoice, we excluded the VAT from the expense because the VAT is basically paid to the supplier, but we will deduct that as input VAT from our VAT before we pay it over to SARS. So that we can already know. It looks to me like they have claimed the VAT or will claim the VAT for VAT purposes. And so therefore, when they recorded the expense, it was only 61,575. So what type of supporting document did we look at? Well, this is the supply invoice that we looked at to confirm this as external proof. What is the date of the invoice? Well, the date is the 28th of April, right? So we can put in that date to know why are we doing it? Oh, not March, 28th of April, 2023. We are wanting to know that they did in fact correctly account for this expense in the right year. So that is definitely an expense in the current year. Who is the supplier? Good Morning Oil Pty Limited. So that's good. The document number, this invoice is G2178, G2187. What is the amount excluding VAT? Well, that is the 61,575.48 that we've already looked at. The VAT is 428.92, and the amount including VAT is 62,004.40. Okay. We can then just drill down to see if there is a difference between the amount. Let's see what this formula is calculating. Between the amount that was accounted for in the general ledger and the VAT exclusive amount per the invoice, which we've already confirmed, but now we've just proven it. Okay. We are going to have to recalculate though, because if you look at the invoice also, this diesel one doesn't have any VAT. So it's not a simple matter as in many of the other invoices where you could have said, oh, yeah, let's just take the total and we do a fancy calculation. VAT is 15, so divide by, divide by 115, multiply by 100, that should give us 61. It's not as simple as that, okay? So there are all these fancy calculations that we could do to get to the answer. I almost want to say quickly or conveniently, but in this case, we can't just do it like that. So we're really actually going to have to look at it in detail. Right. So what we will have to do, and I don't want to spend our time doing that now, but what we will basically need to do is to recalculate the following. Firstly, ask ourselves, is it appropriate that there's no VAT charged on diesel? The answer is yes, there is no VAT on diesel. Right. Is it appropriate that there's VAT on oil? Yes, there is VAT on oil. Great. That's the first point. Secondly, do the recalculation. So 2,800 liters multiplied by 20.97. Does that give me the answer of 58,716? That's the first one. Secondly, they bought 4 containers of 5 liters. Okay, so it's 20 liters, but the 20 doesn't actually matter. It's 4 times the unit price of 714. Does that give me 2,859? Need to calculate that. Does the 4 times 107 give me the total of the VAT? It looks kind of reasonable because at 107, 7 times 4 is 28, 100 times 4 is 4. So 428 looks reasonable. So I'm not too concerned. It looks like that. So I recalculate all of those 20 times, 2,800 times the price, 4 times the price, etc. And then to see that, does the 58 and the 28, if they are correct, get me to 61,000, because then does the 61 plus the 428 give me 62,000? Right, so they basically recalculate everything. Of course, we get fancy software to do it. You can retype it into Excel, you can do all kinds of things, but we have to make sure that it was calculated correctly. Right. In the interest of time, I'm not going to type everything out for you, but that's what we need to check. Good. Then we know that there's no difference. I'm going to assume that all work. I have actually, in preparation for today's session, checked that they are calculated correctly. So I'm comfortable that we can click yes, tick the cost and cross. This is not the cost of the invoice. This is of the general ledger. Let's go and do that one first. So for that, we're going to go to the general ledger, and we want to know that the general ledger account for motor oil or motor vehicles does actually cost properly. So motor vehicles, petrol and oil, that's the general ledger account for expense for motor vehicle, petrol and oil, which includes diesel in this case. So you could go and say, in this case, equals what is the plus that makes the expense more, what is the minus that makes the expense less, and basically drag that down all the way. So you could then basically get a cumulative and sum all of the ones in this column. Or you could just simply go to the bottom of this balance and say, let's sum. And here I will then drag from the bottom to the top. I just find it's easier that way. Then I know I've covered everything. That's the top of motor vehicle oils, okay? Equals, and then Control C to copy, Control V to paste that. And so then I know the total debits is 428,000. The total credits is 21,000. And if I now do that one minus that one, that's the total of 407,000. And I now know that, yes, the export into Excel showed 407, but I now also know that I've casted and cross-casted. I know the total expense is 407,000. Okay, so that's what I'll do there. And once I've done that, then I can now go and tick step 6A to say, yes, I've cast and check the calculations of the GL accounts. Next up, does the details further agree what we've got in the GL to what's in the supporting documentation? That's what we've checked with the invoice. So yes, it agrees. The mathematical accuracy of the source document, we check all those calculations, multiply the quantity times the unit price, check the VAT calculation, etc. And then this question, should expenses have you identified any expenses which should have been capitalized? Now, diesel and oil, firstly, are consumables. What we need to consider, though, is whether these consumables, the diesel and the oil, whether these have to be accounted for as part of our cost of sales process. So in other words, is the diesel and is the oil used in our manufacturing process? Because if that's the case, then this cannot just be expended as a general expense. This needs to then be accounted for as part of the cost of inventory, which will ultimately become cost of sales. in this case, we have determined that this was diesel for, let's say, the generator for the office staff so that they can continue to work and do their accounting. But we need to confirm that these do not need to be expensed, right? If it was, let's say, a machine or some kind of capital item, we would have had to check whether that item should not have been capitalized. Let's say, for example, I bought some items that is just below the tax threshold for expensing items, not having to capitalize them for tax purposes. But then still we need to ask ourselves, should this not perhaps be capitalized from an accounting perspective? All right, but for this purpose now, that's fine. We've determined it is correctly classified as an expense. We've asked the client, we confirmed this is not part of the cost of sales part. Okay, step 7 then is in terms of the VAT. Is the VAT correctly calculated? We check the calculations, that's fine. And then in terms of the VAT, is it correctly accounted for in the accounting records? One thing that you could go and do is to go and check in the actual VAT account, the VAT payable account, which ultimately shows what amount will be paid to SARS or claimed from SARS. That's the one side or leg of the entry. The other leg of the entry, of course, is when we are looking at the actual amount. Now I just want to see this. Oh goodness, is my eye going to miss this one now? 28th of course, I'm looking in March. I keep looking at March, April. There's the 61,575, which is the amount excluding VAT that was accounted for. So they have correctly not included the VAT amount in our expense. And so therefore for today, I'm going to assume it is in the VAT payable account, but please, we will go and check that as well. And so once I've done that, I can sign off the steps to say these have been treated correctly. Right. I'm not going to do the consumables one. We've got that one. You've got the invoice, and that will then be invoice number 5. Please feel free to go and do that by yourself to go and check. What we need to also just check, what we also have to check before we can just move on is we need to check whether the VAT is an appropriate VAT invoice. Now, again, if you hadn't done this yet, or you forgot about it, or you haven't looked at the recording yet, this tax checklist that we've included for you is extremely helpful. So please remember to refer to that when you are looking at invoices. This one is basically saying what is the documentation requirements that a client needs before an item or an invoice is classifying or qualifying as a VAT invoice. In other words, what is all the information that must be on an invoice so that the client can claim the VAT? So in this case, firstly, we've got the amount that exceeds 5,000 Rand. If the amount on the invoice is more than 5,000, these are all the things that must be on that invoice. If it is more than 50 Rand, less than 5,000, well, then the list is somewhat shorter. Okay, so obviously 62,000, that's definitely more than 5,000. So we'll have to check that it has the name VAT invoice. Let's have a look at that quickly. Just want to split the screen again. It says VAT invoice there. Does it have the name, address, and the VAT registration number important of the supplier? So that's Good Morning Oil. There's the name, the address, the VAT number of the supplier. Okay. What is the name, the address of the recipient? So in other words, Wrap Up Manufacturing. Does it have our VAT number? Yes, there it is. Then a serial number for this invoice number that we've recorded, the date of the invoice, an accurate description of the goods and services. We've got the diesel and the oil, the 5 liters, all of those things in there, the quantities or the volumes, and then the value of the supply, the 61,000, the amount of tax charge for 28, consideration applied. Right, so this is a valid VAT invoice, and we've checked that to our checklist. All right, you can do the same steps for the invoice for 5 consumables. And I'm then not going to say too much about what's left here. These are just really all the errors that we picked up from the other invoices. Maybe one thought to leave you here is that the invoice for Open Doors did not comply with the requirements of a VAT invoice. Now, a client does have a period of time, if I remember correctly, they've got 5 years to fix the invoice or to get an appropriate invoice from the supplier. So what we would typically do in this case is we will ask the client to please request the corrected VAT invoice from the supplier. And if we can then get that corrected VAT invoice from the supplier, even within our audit, we can already then basically address this issue and basically not have that issue going forward. So remove it basically from our working paper. So update the working paper once the client shows us the correct invoice. Yes, it does meet the requirements, and therefore then change the note that we've got on the working paper. And then basically this whole the whole note will fall away. All right. So note here that we've got two separate trivial misstatements. The one, yes, being the one about the VAT invoice, but we need a corrected VAT invoice really. So we could address that one, and actually I almost want to say make that one disappear during the audit already, but obviously not through any magic, but through actually appropriately getting the client to get the right documentation. The second one, though, was a misstatement that we identified, and in projecting the misstatement, we came to the conclusion that the total misstatement from the projection is a maximum probably of 11,815. And we can't really get the client to fix 11,815. The client doesn't have anything to go to. It's really just the projected misstatement. So in this case, that will then definitely go to the schedule of audit differences, but still a lot less than our performance materiality, so probably not material, the clearly trivial being 30,000. So even if both of these together was still a misstatement, that would still be clearly trivial overall. Okay, we could still conclude that operating expenses, the misstatement for operating expenses is clearly trivial. Right, that then being operating expenses, I want to give Samu an opportunity also just to check in with us again and to share with us. I'm not going to open the work program for the operating expenses. We have also already referred to that in the recording for operating expenses. But Samu, let's just see also what you want to share for us from your side.
So right now, I won't also open the operating expenses audit program. Again, it's audit programs, they all look similar. When you launch them, they all start with their risk assessment, and they go to procedures that have been included and how you complete, or well, you had completed most of them in Audit International from the exercises in the recording, I think, as well as Pro. Okay, but something I wanted to cover is just a topic. Let me just close this audit program and discard my changes. Something I want to cover, it's about the deleting and recovering documents in Caseway, right? In our session when we're introducing the methodology on the 14th of January, we did cover the tool called the Optimizer Checklist. We did introduce it as a tool that serves to streamline the audit. And one of the capabilities that that tool has is deletion capabilities. When we covered that tool, we did acknowledge that deleting documents, especially critical documents, is a stressful and a scary process most of the time. And to ease those concerns, we did touch on the fact that you are able to restore deleted documents from in your file using the document manager as one of the options. Okay, today I just wanted to show you a similar concept, right, which is using the document manager to recover documents, but now in a case where you had manually deleted the documents. So that can happen either accidentally or intentionally. So you can delete documents. For instance, I'll be using the, what are these? Document 750.10, which is the operating expenses audit program. This technology that I'm showing you applies to both Probe and Audit International, okay? So when let's say by mistake, you right-clicked and you said you wanted to open, but you clicked delete, or you wanted to print and you clicked delete by mistake, or you intentionally thought that you were not going to need the audit program for operating expenses and you deleted it, but later on you find out that you actually need that audit program, right? Let's delete this one and see how we would restore it. Okay. So to recover a deleted document in Caseway, one of the options you have is using the document library. Let me show you how it works. Okay, so you will go to first the home category there at the top, and from the home category, you will find a document. It's just right in the middle. It has an icon that looks like a document and has a plus sign. Then you have from library, okay, with the drop down. When you click on it, you will find a list of all templates that you have installed in your Caseway working papers. Then you are going to select the relevant one. My assumption is that we all auditors today, so the relevant template would be the Audit International if you're using Audit International, and Probe if you're using Probe, okay? If well, yeah, let me not cover the financial reporting part, all right? So you'll click on Audit International. So if you're doing this thing of restoring from library for the first time, you won't see documents like I'm seeing them on my side. You're just going to, here it's going to be blank, but there's going to be a button here saying uncompress. So you'll first need to click that button so that you can be able to see all the documents like I'm seeing them, right? Then the next step would just be you browsing. So this document it's just a copy of the template as you receive it. So it has all the documents, including the documents that you would have deleted. Okay, so you'll go to so in our case, this one is in the risk response folder, and it's a lead sheet. Oh, it's actually in the lead sheet folder, not risk response. Yeah, lead sheets and working papers folder, right? Then we are going to go to expenses. So that's the income statement folder. And we have what are we looking for? Operating expenses. Let's just scroll a little. Yes, there you go, 750. Operating expenses. Which one did we delete? We deleted the first one. Then we can restore it by just clicking and adding. Okay, double click also works. Okay, so that's how you restore it, right? There's just some complications with my file, but that's how it's done, all right? And additionally to this tool of adding from the library, we do have an extra tool that helps your managers and helps your managers protect the filing overall, and also helps the juniors from being protected from accidentally deleting the documents. So that tool just provides extra layer of protection to the integrity and the completeness of your entire audit documentation. We'll cover that tool either later on this session, but only if time allows. If it doesn't, we're going to address it in our next session next time we meet.
In our last topic, we are going to talk about employee cost. Now, employee cost, remember, is part of operating expenses. If you think about your statement of comprehensive income or your income statement, just in a short way, if you think about that, actually, your employee cost will always be part of operating expenses. It's not a separate line item, but there are two buts here. First part is, if you're manufacturing, like wrap-up manufacturing is doing, you could very well find that some of your employee cost has to be classified to the cost of inventory manufacturing, and therefore ultimately lying in your cost of inventory and your cost of sales, right? So that's the first part. And the second part is we test employee costs separately because the way that the line items are accounted for is different to your petrol and diesel that we looked at earlier, your telephone account, your travel cost, etc. So that is why employee cost, or salaries and wages if you want, is audited separately in a different way. So even if we think about it, in the work program, there will literally be different separate steps for testing employee cost. And that's why we've got the operating expenses section with the operating expenses working paper, but then we also have the employee cost working paper. Now, what you will see is we already have in the first section, or in the pre-course work, we've already done a reconciliation of the information that we have from the payroll system. So the client accounts for the payroll transactions in a separate, in our case, not integrated payroll system, which is then processed to the general ledger through journal entries. Now, that was a massive task. So prepare yourself. If you are going to still look at that recording, if you haven't done it yet, prepare yourself. It really is a big task. However, it is probably one of the biggest, most important parts of auditing employee costs, because once you've reconciled the payroll system and you know what the payroll system represents, and you know which accounts link to that and don't link to that, it's very easy to then go and audit the section of payroll to know this expense is part of the payroll section, I'll go and audit it there. Or no, actually, this account is not part. I need to just go and look at that in the GL section. So very, very helpful then for once we've got that reconciliation done, to know that the employee cost is easily auditable. Right. So if we then just go back to the theory and just have a look at this. So firstly, again, we're auditing the financial statements. You know this picture now already. The the big thing here is that the payroll system is our primary source of information to make sense of what's in the GL. Okay? It's not external information. It's not independent or objective evidence like a bank statement, but it is more almost similar to a fixed asset register in that it provides us with more user-friendly version of what's in the general ledger. And that, of course, is then driven by actions that took place, like employing someone. That person belongs to a union, so there's going to be a deduction or contribution to the unions or other deductions, etc. Right. So what we've done then in the pre-course work, we spent a lot of time on making sure that the link basically between the payroll system and the general ledger, that those two things are the same. And so therefore, we could then go and make our selections from the payroll system to ultimately check that what's disclosed in the financials is appropriate. Lastly, just a reminder before we get into the working paper to just remind you that financial reporting framework, again, to say we're using IFRS for SME. IFRS for SME has prescribed policies for how to and when you can account for employee costs and how to account for different types of employee costs. So leave pay, for example, we have to provide for the leave pay because the clients earned that leave pay. We're not going to talk about that today, but just know that there are some requirements in IFRS for SME already. And so whenever we're checking to see did the client account for employee costs correctly, we do actually just go back and say, did they do it in terms of IFRS for SME? Right, so then I want to go to the caseware file and just have a look there at our detailed testing. Good. So as a reminder, we've already reconciled the employee cost. We know that the payroll system is our more user-friendly version. We've checked the completeness and accuracy by doing the reconciliation. The population we've complied. You can see here, we took money. We took the expense from the cost of sales and the expense recorded in operating expenses. And so we are working with a combined 17 million when we are selecting items for testing, etc. We then, in terms of our firm's methodology, we selected 4 items, haphazardly selected, which in our explanation, we also said that this is not just something that we do often, but in some cases you don't have a choice. And then as almost like an advertisement break, make sure that you listen and watch the pre-course work for our next session where we discuss the selection methods in detail. The probe and the AI sampling tools and methodologies are addressed in detail, because next session we're going to look at how do I then actually use those. So this is just quickly to say this is what your senior selected for you, but in the next session we're really going to go and do those selections for ourselves. Right. Then in testing the payroll, we had already in the recording tested 2 individuals. We tested the payroll deductions and calculations for Brett as well as Patrick. What I'm going to do today is I'm going to just test for Philip Sitoli. All right, so there is still another one for you to test, Chris Just, for you if you want to go and test that one as well. But for Philip, just to make sure that everybody is aware of what we've done in the session, and then you can go and watch the other 2 to give you some extra information. So Chris, his income included both night shift, normal hours, overtime at 1.5 times his rate, as well as twice his rate. So what we will go and do is we'll go and have a look at the, I think this came from the payroll system, so we know that that's there. We have already cross-casted it, so there is a formula in there. So all we really need to do is check that the formula works well, and then we can basically just copy this cross-cast sign over to the next line. Right. What we want to go and check, though, is that the payroll system says the company contributions, in other words, this is now over and above the total, what the company had as extra deductions. For Philip, we had an admin levy, a dispute levy, no provident fund, but there's a technology contribution, UIF, and SDL. So again, let's check the cross costs. It includes all of them. So we are comfortable that that's done correctly. The total cost to company is then the income that Philip earned plus the company contribution. So that is the sum of the total gross salary plus the total contributions. That formula is right. And so we'll copy that across as well. All right. Let's go and check whether these amounts are appropriate. So that we will go and get in our supporting documentation. So employee costs, supporting documentation. What are the deductions that the client had? And we will go and look at the bargaining council contributions. In this case, because Philip Sitoli belongs to the bargaining council, we can confirm some of the deductions there. Other places where we can get proof of what the contributions or the deductions are could be, of course, the statement that the medical aid sends to the client every month to say this is what you have to pay over. The pension or provident fund, any of those supporting documents that shows this is what you should do. So the client will definitely be able to give you those documents that you will need. Right, in this case, it's like an extract, but what we've basically just done is just to basically redact what we don't need so that we can quickly and easily find the information for Patrick Sitoli in this case. So actually, I want to take Patrick's that side and the bargaining council there. All right, so if we then look at what deductions were made for Patrick, so admin levy 688, and if we look at both his rates, that's already we can check the rates there, 6111, standard hours that we could go and calculate there. So I'm not going to worry about that too much for now. We've dealt with that. But the admin levy then is 688 for both the employee and the employer. But the employer levy is the one that we are looking at now because this is a company contribution. The dispute resolution, the employer, that's 248, in case you are struggling to see the size. I'm definitely what shall we say, more and more aware of the fact that it's been, what did I say this morning, 20 years since I started my training contract, when I know that I can't see so lucky, I need to actually just increase the size somewhat. Let's just make it slightly bigger, but not too much. Oh, that's the wrong way. I'm scared that if I make it too big, then we still have to scroll around as well. Good. So the dispute resolution levy, that one was the 248, so we were comfortable with that. Then there's a technology levy, no provident, as we can see, technology levy 169, that's right. And the union fees, 97. Now the union fees, that is for for Philip's own information. So that is what we're going to get under the employee income. I see someone's asking for this template. It is in the caseware file. So once you've downloaded the caseware file and the case study, you will have that. The bargaining council is just an example document, but the working paper itself is also in the caseware file. So you will get that there. Right. So we've checked the company contributions and we are then comfortable that all the company contributions are correctly done. So that's fine. Now we can sign off those steps to say, did we cast and cross-cast? Yes, we cast and cross-cast. We've done that by doing CCC, so we've done that. Someone else has already confirmed for us that these individuals actually exist. So they've checked a signed contract, a copy of the person's ID, physically verified them, and checked the latest approved leave record. So that's why I put that little grey done at the top for us. Okay, that wasn't part of our file. It was rather just for us to remember that you can see it's already been done. Someone has also already agreed to the bank statements and agreed the pay rate to the increased letters. So we don't need to do that. Are these expenses correct? Yes, we've agreed all of them to the bargaining council statement. So that's our tick mark that we are doing for that purpose. And then towards the bottom here, this was now the company contributions. Now we're going to look at the deductions for, again, Philip Sitoli. So if I just bring up the bargaining council statement again, there we can see Philip Sitoli. What is the admin levy that we need to deduct from the employee? 688. What is the dispute levy for the employee? 248. And also his union fees. We said that's only for him, not for the employer. And the UIF. Well, the UIF is not on the bargaining council calculation. The UIF is 1% of the cost to company, and that is to a maximum of, and you can see that is basically by default, but you can also just go and Google it or check it. It's basically 17,712 Rand. If you earn more than that, then you are capped at only 1% up to a maximum of 17,000. And so that's why all four of these guys' UIF contribution is basically the same. We'll have to go and test the PAYE. I'm going to show you that at the bottom just now. But basically now we have confirmed that the deductions made from the employee's salary is correct by agreeing those to the statements. Now for calculating the taxable income. And so here, just to remind you that the taxable income, when we are calculating it for the purposes here, we are using South African tax tables and very specifically the tables at the bottom. So they are from February 2023. Please, if you are auditing a client's tax and checking that the tax deduction from employee costs rather was correctly done, don't come and use this table. Right, you always go to the SARS website and you get the SARS tables from there, or your firm's tax booklets or your firm's tax schedules. You probably have a firm working paper that has the latest tables already added in there. Right, so I'm just saying this is a special table for our case study. So please don't just use this in your audit files, because this might be outdated information in your case. Right, so we want to go and calculate what is the tax that needs to be deducted from Philip Sitole's salary for April 2023. Now remember that taxable income or income tax is always calculated at an annual basis. So even if I start working at a company 3 months before the end of the financial year, or I only work there for 9 months or 10 months, then the payroll software will always assume that I'm going to be using it that I would have worked there for a full year. So we will always, what we call, annualize that salary. So just to go quickly, I take the current month's salary and I multiply that by 12, just as a quick way. Of course, as the information is recorded into the system, they can basically calculate the average over all the months, right? So the taxable income for the year then is 261,000. I'm going to just make it slightly bigger because maybe it is a little bit small. 261,000, and then we need to calculate the tax. Now the tax table says that for every amount more than 216,200 Rand, you have to pay 26%. So not 26% flat rate on 261,000, but only on the part that's more than 216,000 Rand. So we are going to calculate, firstly, what is the difference between our tax, our salary, our calculated annual salary, and the previous limit, the previous scale. So that will give us a difference, and for that part, we are going to calculate 26%. All right. Plus, what we are then also going to add is the fixed tax that is already calculated as 18% on that first 216,000. So this then gives us the 50,000 Rand tax that it says is basically what we would have had to pay for the full year had we earned 216,000 Rand on the full year without the rebate. So we're not at the monthly one yet, don't worry, because that's almost like more than double what he earned. We're going to get the primary rebate. The primary rebate is the tax basically that you get back, or that you don't have to pay on the first amount of your tax. All of these guys are younger than 65,000, so we don't have a second and a tertiary rebate, so it's just the first one. The PAYE was then calculated as saying, well, the tax per the scales for the full year minus the primary rebate divided by 12 then gives us 2,916, and the payroll that we had recorded for him for the year that the client had recorded was 2,937. So there is a difference of 21 Rand. Okay. That is small enough, and we can therefore be comfortable that that was not materially misstated. Right, it's close enough. It looks like the client calculated that appropriately. For the UIF, again, the UIF per the payroll, that's calculated as 177.12. What do we believe it should be? Well, we know that that is the total, so there's no difference, and we are comfortable with that. Skills development levy per the payroll, we'll have to go and look for the skills development levy on our employee deduction again for Philip. There we had 217,000. How do we calculate that? Well, now we can cheat. We can see what was in the calculation. We know it's 1% of skills development of the client's salary. Now, maybe just also to say, are all clients required to record skills development levy, to pay over skills development levy? So I remember I had that as a question last year as well. So I want to just confirm that every employer will have to register for skills development levy if they expect that the total salaries that they will be paying over the next 12 months will be more than 500,000 Rand. So it is a threshold before you need to register, but it's really not a very high threshold. So that's why, in all likelihood, the majority of your clients will be registered for skills development levy. So we know then that if they had paid that over, they've done that correctly and all good to go. Right, that was a very fast rush through it, just so that you know what we're doing when we're auditing it. But please, I want to encourage you to, if you have not yet done so, go and watch the recording of the employee cost section. I want to say the majority of that, and I cannot stress this enough, is to explain to you and show you how we reconcile the payroll system to what is recorded in the GL. Right, so that being employee costing.